I've been hearing that some homebuyers are waiting until the new Fed chair is in place to buy a home because they think the new Fed chair is going to lower mortgage rates. And that tells me that I need to clear up some things about how mortgage rates are set, what drives them up and down, what the Fed does that can impact mortgage rates, and also what the Fed has no control over when it comes to mortgage rates. I'm Daryl Fairweather. I'm the chief economist at Redfin. So I think about mortgage rates and home buying all the time. So, first off, let me explain what drives mortgage rates. And in order to do that, I'm going to go back to my days as a PhD student at U Chicago and use something called price theory. Basically, price theory explains the economy through the lens of prices. At U Chicago, we didn't learn about microeconomics or macroeconomics. We learned price theory and income theory, and I'll get to income theory later. But the first thing that you need to understand about mortgage rates is that mortgage rates are essentially the price of being able to borrow money to finance a home. When you get a mortgage from a lender, you agree to pay them back the amount of money that you've borrowed plus interest. And the more that interest rate is, the more interest that you will have to pay. That is the price you are paying for being able to borrow money. So when you start to think about mortgage rates as prices, it's easier to think about the supply and demand that can impact those prices. So let's take chicken as an example. When the demand for chicken increases, the price of chicken goes up. And when the supply of chicken increases, the price of chicken goes down. And the same is true for mortgage loans. When there are more loans available, mortgage rates go down, the same way that when there is more chicken available, the price of chicken goes down. Mortgage-backed securities, as you may remember from the movie The Big Short, are basically mortgages packaged together. If you think of mortgages as being chicken, mortgage-backed securities are like the chicken McNugget. When you get a mortgage, your mortgage is sliced up and it's divvied out into mortgage-backed securities that are packaged together with other people's mortgages and make a more homogeneous chicken nuggety type of product that investors like. Investors don't want to buy individual mortgages. There's too much risk there. They prefer to have their mortgages packaged together, and that makes them less risky. When there's high demand from investors for mortgage-backed securities, that means that there are more funds available to lenders to loan out. And that means that mortgages get cheaper and mortgage rates come down. So now we have to back up and think about, well, what is the demand for mortgage-backed securities? Mortgage-backed securities are a relatively safe investment because US real estate historically has been pretty safe. I mean, there are obviously notable exceptions, but it's pretty safe compared to, say, the stock market. And it's most closely tied to the demand for US Treasuries. When you buy a US Treasury, you are pretty much investing your money in America. And when you buy US mortgage-backed securities, you're doing a similar thing. You're investing your money in America. Now, mortgage-backed securities pay out across about a 10-year duration. That's how long it takes investors to start to make money off of that investment, which is similar to the 10-year US Treasury. That's why those two things are tied together. So you can think of US Treasuries and mortgage-backed securities as being similar investments. They're substitutes for one another. The same is true for other substitutes like chicken and beef. You know, if you're going to go to the store to buy some meat and you see that beef is really expensive, maybe you'll buy chicken instead. They're close enough substitutes such that when investors feel like they aren't getting a good enough return in US Treasuries, they'll put more of their money in mortgage-backed securities, which lowers mortgage rates. So when US Treasury yields go down, that's essentially the return on investing your money in US Treasuries. You can expect that more investors will put their money into mortgage-backed securities, and that means more funds available to lend out as mortgages, which sends mortgage rates down. The important thing to remember is that when investors want to put their money into safe assets, mortgage rates tend to go down. When investors are worried that the stock market is headed down, they tend to pull their money out of the stock market and put it into safer assets like mortgage-backed securities and treasuries. That's one of the reasons why, when there is a stock market crash, mortgages tend to get cheaper. Mortgage rates tend to go down, and that's a benefit to home buyers. Okay, so everything I said so far has absolutely nothing to do with the Fed. There are lots of things that can impact the demand for mortgage-backed securities. The yield on US Treasuries is one. Another is just the overall demand from investors for safe assets. Now, here's where it gets back to the Fed. So, the Fed controls the overnight lending rate, the interest rate that banks have to pay when borrowing money overnight. I talked before about how US Treasuries are on a 10-year duration and mortgage-backed securities are about the same because people tend to hold on to their mortgages for around 10 years. But for the Fed, what they control is the overnight window. It's just half a day. That's the duration of the money that they're lending out. I misspoke. The federal funds rate is the rate at which banks borrow and lend money to one another. So it's not banks borrowing from the Fed. The federal funds rate sets the rate and the rules for how banks can lend money to each other. And one thing that can impact the demand from investors for US Treasuries is what they think that federal funds rate is going to be over the 10-year duration of that US Treasury. So when the Fed goes to lower interest rates, they're lowering interest rates right now. And the things that are happening right now weigh the most heavily on investors' expectations about what might happen in the future. So when the Fed says that they are cutting the federal funds rate by 25 basis points, they don't just say that. They also give some indication about whether they are going to continue to cut interest rates into the future. They give some indication about why they're cutting interest rates, like maybe they're cutting interest rates because they're worried about us heading towards a recession, which would indicate that interest rates could be even lower in the future. So when the Fed comes out and they say they're cutting interest rates because they're trying to avoid a recession, it sends a signal to investors that they should be putting their money in safer assets like US Treasuries and mortgage-backed securities. So that's how what the Fed does can impact mortgage rates. The Fed cutting rates can increase demand for mortgage-backed securities, which drives down mortgage rates for people borrowing to buy homes. But there's another channel through which what the Fed does can impact mortgage rates, and this is where I'm going to get back to income theory. Price theory looks at everything in the economy through the lens of prices. Income theory looks at everything in the economy through the lens of how much money is flowing around in the economy. And when the Fed lowers the federal funds rate, on one hand, they are lowering the price of borrowing money for banks overnight. But on the other hand, they are actually increasing the supply of money. So let me get back to this idea of the overnight lending window. The reason that banks have to go to the Fed to borrow using the overnight window is because banks are constantly lending and borrowing money. And because the economy is fluid and sometimes those loans aren't paid on time and sometimes those loans are paid on variable rates that can go up or down, banks don't know for sure that they're going to have enough money in their reserves the next day to continue their operations. It's like when you go out to dinner with your friends and the bill comes and it's maybe a little bit more than you expected. You put it on your debit card and you worry in the back of your head, am I going to be hit with an overdraft fee? The overdraft fee is kind of like the federal funds rate. When the overdraft fee is really high, you might be less likely to even pay that bill. You might go to a friend and say, hey, can you cover me? Because I don't know how much money I have in my bank account and I don't want to get hit with a fee for it. But when the overdraft fee is waived or it's really low, you might spend that money on dinner, even if you don't have enough money in your bank account, because there won't really be severe consequences for overdrafting your account. When the federal funds rate is low, banks are more willing to lend out money to other institutions or individuals because, on the chance that that money is not paid back, they know that they're not going to be hit with a hard penalty when going to the Federal Reserve and getting one of those overnight loans. And because banks are willing to lend out more money, this increases the supply of money in the economy. because that's money creation. You go to your bank, you get a loan, and poof, you have money in your account, and the bank just waits for you to pay that back. The more money that they're lending out, the more money that people and institutions have in the economy to spend, and that increases the money supply. And when the money supply is increased, that means that those investors who may be wanting to put their money into mortgage-backed securities are more willing to do it because they have more money to invest. And that can drive mortgage rates down. So those are two of the main channels that the Fed can take to impact mortgage rates. There's this other thing that they do, which is more rare. They did it during the pandemic recession. They did it during the Great Recession. It's called quantitative easing. And that's when the Fed buys mortgage-backed securities themselves, directly lowering mortgage rates without going through that channel of the federal funds rate. The Fed has done quantitative easing before, and they've gotten criticism for it. They actually got a lot of criticism for it from Trump's pick for the next Fed chair, Kevin Warsh. He's written multiple op-eds criticizing the Fed for doing so much quantitative easing, buying so many mortgage-backed securities during the pandemic. During the pandemic, mortgage rates hit record lows, and then they increase at their fastest pace on record, and it's distorted the entire housing market. It's one of the reasons we have record low home sales right now. But most people think that when Kevin Warsh gets into power as Fed chair, he's going to do what President Trump has been asking for and lower interest rates. But just because President Trump wants Kevin Warsh to lower interest rates in order to lower mortgage rates and make home buying more affordable doesn't mean it's going to happen. Here's where it could go awry. So before I talked about how when the federal funds rate is lowered, it sends a signal to investors that interest rates are going to be lower now and in the future, which means that mortgage-backed securities, which are on that longer duration, are going to be more attractive, and that lowers mortgage rates. But if the Fed decides to lower interest rates, but the market doesn't believe that they are doing it for justified reasons, it could backfire. A justified reason for lowering interest rates is that you think the economy is heading into a recession, that unemployment is going up, that prices are starting to weaken, and the Fed needs to intervene and lower interest rates. But if markets don't believe that that is actually true, if they think that the economy is strong and lowering interest rates is unwarranted, they will believe that interest rates will actually be higher in the future. Because if the Fed cuts interest rates when the economy is strong, it leads to higher inflation. And that means that in the future, the Fed will have to increase interest rates by even more than they lowered them. So for a mortgage-backed security, which is on that 10-year duration, investors might believe that interest rates on those mortgages are actually going to be higher in the future, not lower, which makes investing in them now less appealing. Investors know that they would just be better off waiting until interest rates go up and they get a better return on those mortgage-backed securities versus buying them now. So it's possible that if the Fed lowers interest rates when it's not justified, investors buy fewer mortgage-backed securities, not more. That could increase mortgage rates, even though the Fed acted to lower the federal funds rate. But that's assuming that this new Fed chair is actually going to be able to lower the federal funds rate in the first place. The federal funds rate is not set unilaterally by the Fed chair. It's set by the Federal Open Market Committee, which consists of the Fed chair, the vice chair, the Fed governors, and a rotation of Fed bank presidents. There are 12 voting members of the Federal Open Market Committee, including the Fed chair. So the Fed chair has to convince a majority of those voting members to vote with him. And the Federal Open Market Committee members care a lot about doing a good job by the economy. They understand that if they were to cut rates and the market doesn't believe that that cut is justified, it could backfire. It could ruin the Fed's reputation and ability to guide markets to do what the Fed wants them to do. So it's going to take a lot of convincing from the Fed chair to get the other voting members to vote with him. So, in summary, if you are thinking about buying a home this year, there's really no reason to wait for a new Fed chair. The new Fed chair is probably not going to do a lot to change mortgage rates. As we've seen recently, the war in Iran has changed mortgage rates more than anything the Fed has done in recent months. What's going on in the economy and in the world matters a lot more for mortgage rates than the actions of the Fed. If anything, the Fed is following the lead of what's happening in the economy and trying to slowly guide it to a more healthy equilibrium. I'm Daryl Fairweather, Redfin's chief economist and author. If you liked this video, please give it a like, subscribe, and stick around for the next video.